While I reviewed the data that came out this morning on CPI, and it was positive relative to expectations, I'm not for cherry picking. I'm not going to show up here and say mission accomplished. And what I'd say is there's plenty of work to do.
All right, that was Federal Reserve Chairman Kevin Warsh testifying yesterday before the House Financial Services Committee. His comments coming after the release of a better-than-expected inflation report. Let's bring in former Treasury official and Morning Joe economic analyst Steve Rattner, who has charts on yesterday's inflation data and oil prices. And there's a lot to cover.
Yeah, Steve, really quickly, before you get into all of this, Kevin Warsh was a deficit hawk in previous incarnations. And then when President Trump wanted him to come on board, he started sounding more like a dove. But is there reason to believe right now that sort of that hawk that he's always been, a man who understands that the last thing you want is inflation kind of getting out of the barn door? Is that who he is again?
Yeah, I think so, Joe. I think he was very clear in his testimony. And I've been talking to some other Fed officials who say the same thing, which is that basically the Fed remains completely committed to getting back to 2% inflation, which is not nearly where we are at the moment. And that is going to mean higher interest rates, probably not at their meeting in July, but later this year. That's what the market is now expecting. It's flipped from before the war. We thought interest rates were going to keep coming down. Now we think they're going to go up a bit in the course of this year, and the Fed remains committed to 2%. So, yes, I agree with you.
All right, let's go to your charts. The first one looking at inflation and how it's impacting workers, Steve.
Right. So here's the point. We did get a somewhat better than expected inflation reading, as the chairman said yesterday. But to Joe's point, inflation is still running 3.5%. Above where it was last year, obviously largely because of oil prices and the war, but nonetheless, that's where it is. The other piece of good news in the number was that wages are also up 3.5%. So essentially, for the first time since the war started, consumers are not losing more ground, but they do remain underwater, so to speak, relative to where they were before the war in terms of purchasing power. Now, obviously, not all consumers are the same. We have obviously people at higher and lower incomes. And so the effect of this is different. And so here's a little data point to show you how it works kind of in the real world. This is a study by the New York Fed on gasoline purchases. And what it shows is that for higher, lower, and middle income people, gasoline purchases have been fairly tight and constant until you had the Iran war started. And then there's been a divergence here where high income Americans have maintained roughly their level of gas purchases. They've essentially absorbed the higher prices, whereas middle and lower income families have had to cut back on their gas purchases. They've had to carpool more, take public transit, or otherwise simply just not use their car quite as much. So an average, but definitely different impacts.
Steve, let's talk more specifically in your second chart about gas prices and why they are still up. They have ticked down since the beginning of the war, since that $4.50 a gallon, but still way higher than they were before the war began. Yeah,
there's an expression economists sometimes use, up like a rocket, down like a feather, in terms of how prices can move. So again, you can see gas prices quite closely tracking oil prices from before the war and even during much of the war as we got to this peak of $4.50 in gas prices. But now crude oil prices came down all the way back to where they were at one point, $72 a barrel. Now they're at 85, but gas never got all the way back down there. Part of it is the reason that I said, that simply retailers of gasoline are trying not to lower their prices, as probably most businessmen would try not to do. But also you've had refinery disruptions and other supply disruptions that have affected refined products like gasoline more than crude oil. But nonetheless, as you know, the U.S. is an oil exporter. We actually produce more oil than we use. And so higher oil prices do benefit our oil companies. And you can see here the impact. This is an index of oil companies, U.S. oil companies. You can see their stock prices are up almost 28% this year. They're making a lot more money from higher crude oil and higher gasoline prices. This is the S&P, up 9.6%. This is the famous Magnificent Seven, the Metas and Googles and so forth of the world, up 2.7%. And these are wages, up 1.3%. So in terms of winners and losers from all this, I think the record is pretty clear.
Steve, as you move to your third chart, we'll tell our viewers the United States military now has reimposed that naval blockade of ships traveling to and from Iranian ports in the Strait of Hormuz. The blockade had been lifted last month after the Memorandum of Understanding was signed, but now back on again as fighting flares. Iran's Revolutionary Guard threatened yesterday to halt all energy exports from the Middle East over that reinstated blockade. President Trump initially had said he also would impose a 20% toll on ships passing through the strait in exchange for providing security, but he walked that back just yesterday, claiming fees will instead be replaced by investments from Gulf allies. So, Steve, how does all this back and forth, this chaos, this uncertainty affect oil prices, and how people who work in this business project where those prices will be?
Yeah, so as we talked about, Willie, oil prices are the fundamental ingredient that has been driving our inflation, and therefore, obviously, what is going on in the Strait of Hormuz, where at one point 20% of the world's oil passed, is very important. So let's put this in a little bit of very recent historical context and look at the Strait of Hormuz. Before the war, 60, 70 ships a day passed through the strait. Then it went essentially to zero. But interestingly, even during the MOU, when we were theoretically the strait was open and we were kind of at, quote, peace, if you will, with Iran, it never got anywhere back to where it was. And now we're back to zero. So that, of course, has affected the market's pricing of oil and perception of future oil prices. Here's where we were before the war, $72, shot up well over $100 when the war started. When we had the MOU and brief peace, it went back actually all the way to $72, and now it's at $85. And so we are looking at higher oil prices as the strait remains closed. And if it were to remain closed for longer, you would see oil prices go up. The other point to make here is that as you go out, the market does not believe oil prices in the next several years at least are going to get back to where they were before the war. There's been a lot of infrastructure destruction. Trump is now muttering about bombing Karg Island, in Iran, which would be a huge problem. And so we should expect that oil prices will stay higher for longer.